Canada's energy sector just received one of the biggest votes of confidence we've seen in years. In a move that's sending shockwaves through the business world, Shell has agreed to acquire Canadian energy producer Arca Resources in a deal valued at roughly $22 billion Canadian. And whether you're interested in energy, politics, jobs, investment, or Canada's economic future, this story matters, because this isn't just another corporate acquisition. This isn't just one company buying another company. This is one of the largest energy investments Canada has seen in recent years, and it could signal something much bigger, a major shift in how global investors view Canada's energy future. For years, the narrative surrounding Canada's energy sector has been dominated by uncertainty, questions about regulations, questions about pipelines, questions about competitiveness, questions about whether global energy giants were losing interest in Canada altogether. Many people believed large international companies were moving away from Canadian energy opportunities. But now one of the world's largest energy companies has made a move worth approximately $22 billion. That forces everyone to pay attention. According to Shell, the acquisition dramatically expands its position in the Montney region of British Columbia and Alberta, one of North America's most important natural gas and liquids producing areas. The company says the deal will add significant production, increase reserves, and strengthen its long-term growth strategy. And here's what makes this especially interesting. Shell isn't making a short-term bet. Companies don't commit tens of billions of dollars because they're optimistic about next month's market conditions. They make investments like this because they believe in the long-term future of an asset, a region, and a country. That's what makes this announcement so significant. It's not just about what Shell is buying. It's about what Shell is saying. The message is simple. Canada matters. Canada's resources matter. Canada's future in global energy markets matters. And apparently Shell believes that future is worth billions. Think about the scale of this decision. Corporate executives don't wake up one morning and decide to spend $22 billion. Deals of this magnitude require years of planning, teams of analysts, teams of lawyers, teams of engineers, teams of economists, thousands of pages of research, countless risk assessments. And after all of that analysis, Shell reached a conclusion. Canada was worth the investment. That's a remarkable statement in itself, especially when you consider how competitive the global energy market has become. Energy companies today have choices. They can invest in the United States. They can invest in South America. They can invest in the Middle East. They can invest in Africa. They can invest almost anywhere in the world. Yet Shell chose to make one of its largest strategic moves in Canada. Why? That's the question everyone is asking. And the answer may tell us a lot about where global energy markets are heading over the next decade. Part of the answer lies in geography. Canada possesses some of the world's largest energy reserves. That fact hasn't changed. What has changed is the growing importance of energy security. Countries around the world are increasingly concerned about where their energy comes from. They want reliable suppliers. They want politically stable suppliers. They want partners they can trust for decades. Canada checks many of those boxes, and that reality has become increasingly important in a world facing geopolitical uncertainty. Then there's LNG. Liquefied natural gas has become one of the fastest growing segments of the global energy market. Demand continues to expand, particularly across Asia. Shell already has major interests connected to LNG development in Canada, and the Arca acquisition strengthens that position even further. In other words, this isn't just a Canadian story. It's a global story, because global energy demand continues to grow, and companies are positioning themselves to benefit from that demand. Shell clearly believes Canada will play a major role in supplying future markets. That's a powerful signal. And it's one that governments, investors, and workers across Canada are paying close attention to, because when a company commits $22 billion, it's not merely investing in oil and gas. It's investing in infrastructure. It's investing in communities. It's investing in workers. It's investing in long-term economic activity. And perhaps most importantly, it's investing in confidence. Confidence that Canada remains an attractive place to do business. Confidence that Canada's resources remain globally competitive. Confidence that the country's energy sector still has a major role to play in the decades ahead. The real question now is whether this deal marks the beginning of a broader trend. Could other global companies follow? Could additional investment flow into Canada's energy sector? Could this become the first chapter of a larger energy resurgence? Those are the questions that will dominate discussions in boardrooms and government offices across the country. And if the answer is yes, the implications could be enormous. Because this story isn't just about one deal. It's about what that deal may represent. A renewed belief in Canada's economic potential, a renewed belief in Canada's energy future, and a renewed belief that global capital is once again willing to make very large bets on Canada. Now, if you really want to understand why this deal is generating so much excitement, you have to look beyond the headline figure. $22 billion is a massive number. It's the kind of number that immediately grabs attention. But sometimes the most important part of a deal isn't the dollar amount itself, it's what that dollar amount reveals. Because when a company like Shell commits billions of dollars to a single transaction, it's effectively making a statement about the future, and that statement is worth examining carefully. Think about the energy industry for a moment. Few sectors are more exposed to long-term risk. Energy companies constantly have to make decisions that won't pay off for years or even decades. They're not just thinking about today's prices, they're thinking about future demand, future technologies, future regulations, future economic growth. Every major investment is ultimately a prediction about where the world is heading. That's why Shell's move is so significant. This isn't a company making a short-term trade. This is one of the world's largest energy producers making a long-term commitment. And that commitment suggests confidence in Canada's role within the global energy system. Now, let's talk about the Montney region, because it's central to understanding this deal. For years, industry experts have described the Montney as one of North America's most important energy resources. Located across parts of British Columbia and Alberta, it contains enormous reserves of natural gas and natural gas liquids. In many ways, it's become one of Canada's most valuable energy assets. The reason is simple. The world wants energy that is reliable, abundant, and increasingly efficient to produce. The Montney offers exactly that. Companies operating there have spent years improving technology, lowering costs, and increasing productivity. As a result, many analysts view the region as one of the most competitive energy-producing areas in the world. That's a major reason why Shell appears willing to invest so heavily. The company isn't just buying production, it's buying access to resources that could remain valuable for decades. And that's where the bigger economic story begins. Because when major international investors place large bets on Canadian assets, they don't just affect the companies involved, they affect entire regions, they affect local economies, they affect employment opportunities, they affect future investment decisions. A deal of this magnitude sends signals throughout the market. Other investors notice. Other energy companies notice, financial institutions notice, governments notice. Everyone starts asking the same question. What does Shell see that justifies such a large commitment? That question matters because investment often attracts more investment. Confidence can be contagious. When a respected global company commits billions to a market, it can influence how others evaluate opportunities in that same market. That's one reason these transactions often have effects that extend far beyond the companies directly involved. Now, critics of the energy industry may view this development differently. Some will argue that the future belongs primarily to renewable energy. Some will argue that oil and gas investments face increasing long-term challenges. Others will point to climate-related concerns and evolving energy policies. Those debates are real, and they're likely to continue for years. But even within those debates, one fact remains clear. The world continues to consume enormous amounts of energy. Demand remains substantial. Population growth continues. Economic development continues. Industrial activity continues. And all of those trends require energy. The challenge facing governments and companies is determining how that energy will be supplied. Shell's decision suggests the company believes natural gas will continue playing a major role, not just next year, not just 5 years from now, but potentially for decades. Whether one agrees with that outlook or not, it's clearly influencing major investment decisions. And when billions of dollars are involved, those decisions deserve attention. Another important aspect of this story is what it says about Canada's competitiveness. For years, Canadian policymakers have faced a difficult balancing act. On one hand, there is pressure to encourage economic growth and attract investment. On the other hand, there are environmental goals, regulatory requirements, and political considerations that must also be addressed. Finding the right balance hasn't always been easy. Businesses frequently discuss regulatory certainty. Investors frequently discuss predictability. Companies making long-term investments want confidence that rules won't change unexpectedly. They want confidence that projects can move forward. They want confidence that major commitments will be rewarded rather than undermined. The fact that Shell is moving ahead with such a large transaction suggests the company sees enough opportunity to justify those risks. That's an important signal. Because in a highly competitive global economy, capital doesn't have to stay in one country. Money flows where opportunities appear attractive. Companies compare jurisdictions constantly. They compare costs. They compare regulations. They compare infrastructure. They compare political stability. Canada competes against dozens of other investment destinations around the world. Yet in this case, Canada won. That's worth noting. It's also worth considering what this means for workers. Whenever people hear about billion-dollar deals, attention often focuses on executives and shareholders, but major investments have broader consequences. They support jobs. They support contractors. They support suppliers. They support communities that depend on energy development. Entire local economies can be influenced by decisions made in corporate boardrooms thousands of miles away. That's one reason energy announcements frequently generate strong reactions. People understand that these decisions affect livelihoods, they affect families, they affect regional development, and they affect future opportunities. Of course, no major deal is guaranteed to deliver every benefit supporters hope for. There will be challenges, there will be scrutiny, there will be questions from regulators and policymakers. That's normal. Large transactions always attract attention, but the scale of Shell's commitment is difficult to ignore. $22 billion represents more than a business decision. It represents confidence. Confidence in Canadian resources, confidence in Canadian production, confidence in Canada's ability to remain a significant player in global energy markets. And perhaps that's the most important takeaway from all of this. Because beyond the financial details, beyond the headlines, and beyond the political debates, the core message is remarkably simple. One of the world's largest energy companies looked at the future and decided Canada was worth a massive bet. In an era when global competition for investment is fiercer than ever, that's a message that resonates far beyond the energy sector itself. And the ripple effects of that decision may only be beginning. Because while most people are focused on the size of the deal, the real question may be what happens next. History shows that major investments often create momentum. One large deal attracts attention. That attention attracts more investors. Those investors begin looking for opportunities of their own. Before long, an entire sector can experience renewed interest. The reason is simple. Investors watch each other closely. When one of the world's biggest energy companies makes a move worth billions of dollars, people notice, competitors notice, investment funds notice, banks notice, governments notice. Everyone wants to know what the company sees. And that's especially true when the investment involves a country that has faced years of debate about its energy future. For a long time, Canada has found itself caught between two competing narratives. The first narrative says Canada is one of the world's great energy powers, a country blessed with vast natural resources, a country with a highly skilled workforce, a country with stable institutions and strong rule of law, a country capable of supplying energy to global markets for generations. The second narrative paints a more uncertain picture. It emphasizes regulatory challenges, infrastructure bottlenecks, political disagreements, environmental controversies, and concerns about whether Canada can remain competitive in an increasingly complex global marketplace. For years, these two narratives have competed with each other. Depending on who you ask, Canada has either been an energy superpower waiting to unleash its potential or a country struggling to capitalize on its natural advantages. That's what makes Shell's decision so important, because actions often speak louder than words, and a company doesn't spend approximately $22 billion based on political slogans. It spends that kind of money based on analysis, data, forecasts, long-term projections. The company looked at the opportunities, it looked at the risks, it looked at the alternatives available around the world, and after evaluating everything, it decided to move forward. That decision sends a powerful message. Now, let's consider the global picture. Energy demand isn't disappearing. In fact, many forecasts suggest global demand will remain substantial for decades, even as the energy mix evolves and new technologies emerge. Developing economies continue to grow. Industrial activity continues to expand. Populations continue to increase, and all of those trends require enormous amounts of energy. The debate isn't whether energy will be needed. The debate is what kinds of energy will dominate and how quickly transitions will occur. Natural gas occupies a unique position in that discussion. Supporters view it as a critical fuel for economic growth and energy security. Critics argue that greater emphasis should be placed on accelerating alternative energy sources. Regardless of where people stand in that debate, companies like Shell are making decisions based on where they believe markets are heading. And this acquisition suggests confidence that natural gas will remain a significant part of the global energy landscape. That matters because Canada is exceptionally well positioned in that market. The country possesses vast reserves, it has access to major export routes, and it has growing connections to international LNG markets. Those advantages are difficult to ignore, particularly at a time when countries around the world are seeking reliable energy suppliers. Reliability has become one of the most valuable commodities in the modern economy. Governments want dependable partners, businesses want dependable partners, consumers want dependable partners, political stability matters, economic stability matters, and Canada has historically been viewed as a relatively stable place to invest. That stability may be one of the factors helping attract large-scale capital commitments. But there is another dimension to this story that deserves attention: national confidence, economic confidence, public confidence. For years, discussions about Canada's economy have often focused on challenges: housing affordability, productivity concerns, slower economic growth, rising costs, political uncertainty. These issues are real and deserve serious discussion, but major investment announcements can sometimes provide a different perspective. They remind people that international investors still see opportunity. They remind people that global companies are still willing to commit significant resources. They remind people that Canada remains competitive in areas where it possesses genuine strengths, and energy is undoubtedly one of those strengths. Whether people support the industry or oppose it, Canada's resource sector remains a major contributor to economic activity. It generates jobs, it generates exports, it generates government revenue, and it plays a significant role in regional economies across the country. That's why developments like this attract so much attention. They're not simply corporate news, they're economic news, political news, national news. The implications extend far beyond a single boardroom transaction. Now, there will undoubtedly be debate about what this deal means. Some will celebrate it as proof that Canada's energy sector remains globally attractive. Others will raise concerns about consolidation, environmental impacts, or long-term industry trends. Those debates are inevitable, and they're healthy. Large investments should be examined carefully, questions should be asked, claims should be scrutinized. That's part of a functioning democracy. But regardless of where those debates lead, one fact remains difficult to dispute. A company with countless options around the world chose to commit billions of dollars to Canadian energy assets. That fact alone carries significance, because investment is ultimately a form of confidence. When people believe in a future opportunity, they invest. When they don't, they look elsewhere. Shell had the ability to look elsewhere. It had opportunities across multiple continents. It had alternatives in numerous markets, yet it chose Canada. And that's why this story is bigger than a single acquisition. It's a statement about the perceived value of Canadian resources. It's a statement about Canada's place in the global energy economy. And it's a statement about where one of the world's largest energy companies believes future opportunities can be found. As the details continue to unfold, Canadians will be watching closely. Investors will be watching closely. Governments will be watching closely, because this deal may end up being remembered not only for its size, but for what it represented. A moment when one of the biggest names in global energy made an enormous bet on Canada's future. And if that bet pays off, it could influence investment decisions, economic development, and energy policy discussions for many years to come. The headline may be about $22 billion, but the real story may be about confidence. Confidence in Canada's resources, confidence in Canada's potential, and confidence that the country still has a major role to play in supplying energy to a world that continues to need it. Now let's talk about the political implications, because that's where this story could become even more consequential. Whenever an investment of this size lands in Canada, politicians immediately begin paying attention. Why? Because major investments don't happen in a vacuum. They influence debates about economic policy. They influence discussions about regulation. They influence conversations about taxes, infrastructure, energy development, and Canada's broader economic strategy. And in this case, the timing couldn't be more important. Canada is facing growing pressure to improve productivity, attract investment, and strengthen long-term economic growth. For years, economists have warned that Canada needs more capital investment, more business investment, more infrastructure investment, more productivity-enhancing investment. Without those things, economic growth becomes harder to sustain. Living standards become harder to improve. Competitiveness becomes harder to maintain. That's why a transaction worth roughly $22 billion attracts attention far beyond the energy sector, because at its core, this is also an investment story. It's a story about global capital choosing Canada, and in today's economy, that's something governments desperately want to see. Think about the competition involved. Countries all over the world are trying to attract investment. The United States is competing aggressively. European nations are competing aggressively. Asian economies are competing aggressively. Every major economy wants jobs, capital, innovation, and growth. The competition is relentless. Companies can choose where they invest. They can choose where they expand. They can choose where they build. And every country is trying to make its case. In that environment, winning a major investment matters. It sends a signal that investors still see opportunities, a signal that resources remain valuable, a signal that Canada can still compete on the global stage. Now, that doesn't mean every challenge has been solved. Far from it. Canada still faces serious economic questions. Questions about productivity, questions about infrastructure, questions about permitting timelines, questions about competitiveness. Those issues aren't disappearing because of one transaction. But large investments can change the tone of the conversation. They can shift perceptions. They can remind people that global investors are still paying attention, and perception matters. Confidence matters. Momentum matters. Because economies are influenced not only by hard numbers, but also by expectations. When investors become optimistic, investment tends to increase. When businesses become optimistic, hiring tends to increase. When consumers become optimistic, spending often increases. Confidence can have real-world effects. That's one reason governments work so hard to attract investment. Not just because of the direct economic benefits, but because of the message it sends. The message that opportunities exist, the message that growth is possible, the message that the future may be brighter than critics suggest, and this deal arrives at a moment when that message carries particular significance. Over the past several years, conversations about Canada's economy have often focused on limitations, what Canada can't do, what Canada struggles to build, what projects face delays, what investments might go elsewhere. Those concerns haven't vanished, but Shell's decision introduces a different narrative, a narrative centered on opportunity, a narrative centered on growth, a narrative centered on one of the world's largest companies deciding that Canada remains worth a massive commitment. That doesn't happen by accident. Companies evaluate risk constantly. In fact, risk assessment is one of the most important functions in modern business. Executives examine political risks, economic risks, market risks, regulatory risks, technological risks, environmental risks. Every major investment is subjected to intense scrutiny. The larger the investment, the more scrutiny it receives. That's why this story is so revealing, because it tells us something about how Shell views those risks. Clearly, the company concluded that the opportunities outweighed the concerns. Otherwise, the deal wouldn't exist. And that conclusion is worth paying attention to, because companies often reveal their true beliefs through their actions. Press releases are one thing, advertising campaigns are one thing, actual investments are something else entirely. Money has a way of clarifying priorities, and when billions of dollars are committed, the signal becomes impossible to ignore. There's also a broader international dimension here. Around the world, countries are increasingly focused on energy security. Recent years have demonstrated how vulnerable energy markets can become during periods of geopolitical instability. Governments have learned difficult lessons about supply chains. They've learned difficult lessons about dependence on unreliable suppliers. They've learned difficult lessons about the importance of stable energy partnerships. That environment creates opportunities for countries like Canada, countries with abundant resources, countries with relatively stable political systems, countries with strong legal frameworks. Countries capable of supplying energy over long periods of time, those advantages may become increasingly valuable in the years ahead. And Shell's investment suggests the company sees value in positioning itself accordingly. Now imagine where this story could lead if additional investment follows. Imagine if other major companies decide to expand their Canadian operations. Imagine if infrastructure development accelerates. Imagine if energy exports continue growing. Imagine if international demand remains strong. The economic implications could be substantial. We're talking about jobs, revenue, infrastructure, investment, growth. The effects would extend well beyond a single company. That's why some analysts are already asking whether this deal could mark the beginning of a larger trend. No one knows the answer yet. Markets are unpredictable, conditions change, new challenges emerge, but major investments often create momentum, and momentum can become a powerful force. For now, however, one thing is certain. This announcement has changed the conversation. Instead of asking why investment isn't coming to Canada, people are discussing one of the largest energy transactions in recent memory. Instead of focusing exclusively on uncertainty, they're discussing opportunity. Instead of debating whether Canada can attract major capital, they're examining a deal that demonstrates exactly that. And sometimes that's how larger shifts begin, not with a dramatic transformation overnight, but with one major decision that causes people to reconsider old assumptions, one investment that changes perceptions, one deal that forces everyone to look at a country, an industry, or an opportunity in a different way. Whether Shell's $22 billion move ultimately becomes a turning point remains to be seen. But there's no question it has become a powerful statement, a statement about confidence, a statement about resources, a statement about long-term opportunity, and perhaps most importantly, a statement that Canada remains very much in the game when it comes to competing for major global investment.